In this video, we'll look at Binance's crypto trading bots. We're going to concentrate on the spot trading bots in this video. So that is the rebalancing bot, spot DCA, auto invest, and spot algo orders. What are they and how do they work? Well, they're actually really good tools that can help you with your trading. And so we'll go over what they are and how they can help in this video. If you want the spot grid, I'll leave that in a separate video because it's its whole thing. I'll leave that linked down in the description. I'll also leave timestamps for all of these bots down there as well if you want to skip around. We'll start with the auto invest feature then, and this is where you can just buy into the cryptos that you want to invest in a regular pattern. So you put some dollars down or some fiat currency down at regular price intervals. So we click auto invest and that goes through here. Now, depending on which country you're in, you may not have access to all of these features. So you're just going to have to check in the country that you live in. So, if you have access to them, great. If not, you obviously can't use them. But historical ROI, you can see here, this is if you had invested a set amount over a certain period of time. As you can see, with shorter periods investing, of course, you don't make as much because the price can't move as much in a day or 7 days as it can in 5 years. Now, all these tokens have performed very well in the past, but of course, that is not an indicator of future potential performance as well. So, dollar cost averaging isn't some panacea that makes us all make money. You have to obviously invest in the right tokens that are actually going to go up over that time. Most people do dollar cost average simply because they have a wage that comes in, and so they set a percentage of that into the assets that they want to buy, and that's the only way they can kind of increase the amount that they have. So from here, you can just simply create a plan. So we're going to go to create a plan on BTC. And as you can see here, you can actually add coins. So if you want to have BTC and other coins, you can do that. But I'll just stick to BTC now. You can buy with a card. So what that does is essentially charge the card automatically every week, let's say. You can also just put dollars or your fiat currency into Binance in a lump sum, and then use Binance to kind of split it up over time. So Bitcoin allocation, 100% here. So we're just doing one coin, amount per period. Let's do $100. And as you can see, it comes from our spot wallet. So as you can see here, my spot wallet doesn't have $100 in there. It has 13 or USDT. And so if you don't have enough, obviously it's not going to buy it for you. So it's not going to buy anything that you can't afford from the wallet. You can set it up with your card though. That's slightly different. So you can just set that up as a kind of, automated card purchase each time. But I have USDT in here. You can use others, as you can see. So if you have maybe some fiat currency, if you're in Europe, Euro, Brazil, you can actually use that with fiat just to buy. So you can check those details. But it's coming from my spot wallet, simple earn wallet as well. So what you can actually do is put US dollar Tether or some of these other stable coins on Binance, and then you can switch them over to that simple earn product. So we won't go through that in this video, but it's simple earn. I've got the earn tutorial down below if you want to watch it, but essentially you can swipe over the dollars that you have in your spot trading account into simple earn, and you can put them in and take them out immediately. You may lose some interest on the day that you take it out if you do that, but simple earn may pay a very, very small, percentage interest rate on dollars or, USDT. So what you can do is keep the dollars in there, earning a small interest, and then when your DCA comes up, it takes the US dollar Tether out and then buys the crypto that you want to buy. So that might just be, up to you if you want to do that. But as we can see here, we're going to choose weekly. So we buy $100 a week on, let's say Monday, something like that, right? So that just sets it up. You can even set the time. Very simple. This buys into the asset that you want, set intervals and amounts. Now, this isn't necessarily better than lump sum, right? The best way of buying is just to buy the most at the cheapest price. But like I said, most people can't do that. They don't have a lump sum. They get their wage. And so this is just a way of kind of, consistently investing over time, especially in bear markets when prices are lower. A lot of people will go through this. You can see the summary here, agree to the terms and then confirm that as a DCA. So that's that. And what we'll do also is go to recommended. Now, what these are is just easy ways to allocate to maybe more than one crypto if you want to do that, right? So what you're doing here is maybe, let's say you're just not sure about altcoins. You know that altcoins may go up in a bull market. You're not really sure. So what you can do is just allocate to a group of them. Now, what this is doing is essentially creating a portfolio for you, right? So you may say, look, there's these 10 altcoins, the top 10. I don't really, I want kind of exposure to this asset class, but I'm really not sure, which one is the best. So what you can do is just kind of broadly diversify in them. So again, BETH ETC duo, if we see this, it's just 50-50 Bitcoin and ETH. So if you go copy, you're not copying anything, you're just setting up your own bot. You can change this around. So let's go 70% ETH or 80% ETH, Bitcoin, sorry, and 20% ETH. And then you can just set up exactly the same, right? So that just, very easily dollar cost averages in for you. You can also do top 10 invest as well. So you can see the allocation. It's literally split evenly between them. What do I think of this? It's up to the individual, of course. I would say, there's going to be some in here that I just wouldn't want to invest in. And, Litecoin, for example, I just think it's going to be outperformed by, many others, including BTC over the long term. So it's up to the individual if they want exposure to these. For me, just sticking with what's worked over time, but that's up to the individual. Just to show you it can be done pretty much in any way that you want. Any assets that are supported on Binance, you can set it up with that dollar cost average. There's also this, which definitely won't be available in some countries because this is essentially a securitized product. So this is a cap weighted index, which means it puts the exact same amount of money into each coin, irrespective of how large it is in comparison to the others. So if you've got $1,000, that's $100 into each coin, and that's it. And it's actually going to rebalance that as well. So even if one of the coins does really well, it's going to try and balance the coins. So I don't really like equal weighted indexes. Most indexes are cap weighted, which is, like the S&P 500 or the NASDAQ. The bigger companies are weighted higher. You just put more of your money in those over time. And so what that does is kind of just put most of the money into the most successful companies if you're in an index for a very long time. So equal weighted, not great for me, especially with crypto, because, a lot of these coins are in and then out. And so, really you just want to be investing in probably the most successful ones. But in any case, what we can see is on a weekly basis, over the since October, it's kind of flat, right? So it hasn't really performed that well, but indexes are really for long-term investing. So, maybe not really suitable for a lot of people, this one, but it's an option anyway. Or you can just, use the allocations here to just dollar cost average into a set of coins that you want. Now we'll look at the rebalancing bots, which is just a manual way to do what we've just seen in the auto invest features. So rebalancing bot here, then you can do this manually. So we can actually choose lists of coins that have already been chosen, or we can set them up manually. If we go to AI rebalance here, we'll just press create. It says AI, but this is essentially just a pre-populated list of coins. And as you can see, you can rebalance. So you can turn this on or off if you want. If you turn it off, then you just don't auto rebalance them. So you get this in a list and, percentages, and then that just kind of stays as it is, right? So we're just going to put this on, and then by time, to rebalance, if you're looking at long-term investing, rebalancing every day would be way too much, right? And you're going to be trading these as well and paying trading fees. So I would just put this right to 28 days and just leave it there because, everything I had learned when I was investing and working was, don't sell winners to buy losers, right? And that's what rebalancing does. So it's a very specific use case if you think you need it. But just setting up a list where you're constantly selling coins that are going higher to buy kind of coins that aren't or are underperforming is obviously a little bit strange. But you can either do it by time or you can do it by ratio. So you can set a ratio at which they rebalance. So you can set it up for yourself, and then you just make an investment here, agree to the terms and create. What we can also do is manual. So we'll just add some coins here. So add coins, let's choose BTC, and then we'll choose ETH like this. And you've got the 2 coins there. So I'll just press confirm. And then you have them both right here. So these are 6% each. You have a remaining allocation of 80%. So what we'll do is 80 here, and then we can do 20. So now you have 100% of your allocation that you're going to put into these coins. And then the allocation is either equal, 50-50, or by market cap. You can see it actually puts them this way. So that's quite good. So, what you're saying here is that you're putting them in by market cap. So how are they going to react over the next, year or so if you're investing for that time horizon? Do you think ETH is going to outperform? And so if that does, you're going to be selling ETH and buying Bitcoin. Do you think Bitcoin is going to outperform? And so you actually want to sell Bitcoin to then buy some more ETH because you think maybe during this part of the cycle, Bitcoin will outperform and you want to make some profits and put them into ETH because ETH is going to outperform a little bit later. But again, you would have to actually then stop the rebalancing bot before that happens as well. So the rebalancing bots, they have a very specific use case. Not something I, do to ever really, because I was always taught that, when I was investing, if we were managing portfolios, the ones that win, you keep them, right? If you're winning in a position, you don't sell it to buy the one that's underperforming, but that's up to the individual. Just put the investment in here. Auto rebalance, you can turn on or off actually after the initial allocation, right? So once you've allocated, you can just turn that off. And then either by ratio, so when they become unbalanced, or you can just do it by time. Like I said, 28 days is probably the least that you want to be trading this, because if you're literally rebalancing all of the time like this, you're going to be paying trading fees, and this is just, it's too often. Now down here, you can set some additional options. So trigger prices when you actually start the rebalancing bot. So you can either start it right away, or you can say, if Bitcoin falls down here to this price, I can then start it. So you might just want to leave that off. The stop trigger is once you're in a certain loss or a profit in the rebalancing bots, then you'll actually get out of the position. So if you're making a 20% loss in each of these, as your entries, right? So you're actually losing 20% of each of the positions, then it will actually sell you out at that loss to prevent further losses. So you can say, if I'm losing 20% in this rebalancing bot, just sell me out anyway. And there's a take profit target here as well if you wanted that. And as you can see, sell all coins on stops. So if you put these stops in, then what it will do is sell all coins. So you can just click that on and it will sell all the coins in your rebalancing bot. And so you won't have any more. That will go back to the stable coin, which is US dollar Tether. I have read, and then just press create. Now we'll look at spot DCA, which is a little bit different than what most people would assume DCA to be, which is just, investing at regular intervals. This is more active. And so it's more for shorter term trading. So with DCA, what this is essentially doing is trying to buy during downturns and dips in order to get a better entry price for a trade, in order to then sell it on a potential rip upwards. So if I just show you on the chart right here, these are two actually good scenarios in which this bot would have worked. So what we're seeing is the price is coming up into a resistance level, right? And during resistance, you do expect, if you're testing it for the first time, that you maybe get rejected a little bit from that resistance. So what the DCA is doing is trying to buy an amount in your trade, not all at once, right? So maybe the bot comes down, and instead of saying, well, I'm just going to enter here and try and take the trade, what it does is you can set it to kind of buy like this at regular intervals, maybe let's say 1% apart. So what you're looking to do is kind of enter a trading position during the downturn or the kind of sell-off, and then trying to sell once it goes above a certain price. So it's a little bit like grid trading bots, if you've seen those, but a bit different, because you're entering a position, trying to get better entries, and then selling everything at once if it breaks above your entry level. So price settings, you can see here. Price deviation is, we're going to be setting up a bunch of orders, right? So if you're making a trade short term, you can either invest everything at once, or enter your trade at once, or you can say, I have $1,000 to invest. I'm going to set up 10 entry orders, 1% apart. So the price deviation I've got here is 1%. The take profit, you can put in a fix. So a fixed is once, let's say you've got in an average price, whatever it is, once the price moves up and you're in 5% profit, you sell out of that trade. All right, so we're just going to put 5% here. Now you can also use trailing. Trailing stop is essentially, well, you know what a trailing stop is. It's going to follow the price upwards, but it doesn't follow the price down. So let's say you're in a 5% profit here. What is the trading rate? It has to be underneath your profit rate. You can't have it above the profit rate. Let's say 3%. So what this is going to do is, once your take profit is hit, so let's say you've entered your positions, you've entered 10 positions, and you're in 5% profit now. What will happen is, if you just put fix here, you sell out straight away at that 5% profit. With trailing, what happens is you enter a trailing stop order at 3% below whatever that price is. So remember, we're in 5% profit because the price moved up, but we're not selling yet. We're going to enter a sell order 3% below that price. So if the price moves up and we're in 5% profit, and it moves immediately down and only down, and we're then in 3%, so we're 2% profit, right? 3% away from that, we'll sell for 2% profit. Now, the reason for this is because this stop order follows upwards. So if we're in 5% profit, maybe the price goes a bit higher still. Well, the stop order is going to follow it up and keep at that 3% distance. So we are trying to eke out more profit in the trade. If the trade moves upwards continually, that trading stop will just keep moving upwards until it starts moving down again and hits the stop. So that's what a trading stop is. So you can say, once we're in 5% profit, I want a trading stop 3% away. And if we move up, then we might eke some more profits out of the trade. If it doesn't, then we're only going to make a 2% profit. So you can choose that as you want. Let's just put fix it on here for now. So base order size, that is the first order that you trade. And that will usually be done at whatever entry price that you press and start the bot at. And then the DCA order size, right? So first order is 100, and then each of the remaining orders is 100, and I've got 10 DCA orders in here, right? So total 1,100 because you have a base, and then you have DCA orders, right? So 11, so 1,100 overall. Now what you can do is choose the additional options if you want. If you don't, then you just press create, right? So we have an entry of $100 at whatever price it is now. And then if the price keeps moving down from here by 1% each time, we'll put those orders in. Now the additional options, trigger prices, if you don't want to enter right away, so if the price here of Bitcoin is 34,486, you don't want to start your orders until like 32 maybe, right? Because you're looking maybe for, the price to be coming down into this support level maybe. And that's what you want to be kind of entering orders into, right? So maybe you're going to start at 32K. And that would be the first order. Now, price deviation multiplier, I would keep this as nothing. You can just see that above my head. I wouldn't change this. It's set to default as 1. If you change this deviation number, it starts getting crazy, and then the percentages get out of whack. So I just leave that out. The DCA size multiplier as well, you can. But you can see if you start multiplying the order sizes, you start investing a lot more, right? So what this is for is more of what's called a martingale strategy, which is essentially starting off an order in a small amount, right? So entering an order in a small amount, maybe $100. And then if the price gets down, you start putting more in, right? So $100 to start. If it goes down 1%, you put 200. If it goes down another percent, you put 300. So again, that's up to the individual, whether they want to do that or they just, leave it as is. Obviously, the more you invest at lower prices, your average price will be coming down more. Because you're investing more nominal dollars at those prices if you wanted to do that. There's also a cool down as well. So this would be good if you're more actively trading in your bots and essentially the price just kind of dumps 5%, right? Then it's going to give you like a minute to kind of maybe cancel the bot because maybe you're thinking, whoa, like what's happening here, right? Like a piece of news came out and your bot's going to get wrecked. It's just going to get, hit all these coins, and you can have 60 seconds to cancel the bot if you want to. So you just put less nominal in and cancel it. And then this is the stop loss as well. So you can actually make a kind of grid here as well. So if you have a lower and upper bound for the bot to work at, so this lower bound is saying, around here you actually want to stop the bot. And if it goes lower, then obviously you don't want to keep buying. Again, that you can work that out from your order sizes as well, right? So if you've got 10 orders in at 1% difference, you're buying down at 10%. And then the stop loss as well, which you can put in. So if you have gone into all of the orders, so you've bought in a 10% pullback, and it then goes another 5%, you're like, okay, maybe I got this one wrong. And if it goes down 6%, then we're just going to sell out this whole entire trade. So this isn't dollar cost averaging as such. This is more of a, buy pullbacks kind of strategy, but there is also the take profit here as well. So it's more of a short-term strategy, not investing as such, but buying pullbacks, hoping for kind of another expansion phase. And this type of bot would have worked well in this current environment, which is an uptrend with pullbacks, right? So if you'd started the bot on these pullbacks, you would have done pretty well, 1, 2, 3, 4 times for this price action. So it has its uses, but more specific. Now we'll look at spot algo orders, which are actually much simpler than they sound. These are just a way to get a decent trade execution for what you want to do. So we'll click on spot algo, and then there's two options here. You can either trade via TWAP, which is time weighted average price, or by POV, which is percentage of volume. For most normal users, TWAP is probably the one. So what this is going to do is just enter your position, however you want to trade it, either buying or selling, and then over a set period of time. So we've all been in that position where we do our, buy for the day, right? And then the price drops 3%. And you're just like, thanks a lot, right? Always happens. So what you can do is just say, today's my buy day, and I just want to get kind of an average price as to what traded over that time, right? So let's put a buy. So we're going to choose USDT, and we're going to buy BTC here. Amount of BTC that you want. So let's say 0.02 or something like that. Bitcoin, right? So that's how much we want to execute. We're buying, and we're going to have the time weighted average price over the next 8 hours and 1 minute, right? So what we're doing here is saying we just want a similar price to what was traded over that time, and the TWAP, it's going to be an average over that time, and then you can put a limit, as in the price of Bitcoin is currently 34,800. I don't want to pay over 35,000. So that's kind of my limit. But anything under that, I'm happy to execute over the next 8 hours. If the price goes above 35, obviously you're not going to buy because that's a limit order. POV, percentage of volume, right? And so what you're saying is over a specific time period, I want to trade as a percentage of the volume traded. So if you think you have, let's say, an order of, 0.02 BTC, and you've got an order expiry time of, let's say 8 hours, right? So you set this up to be another 8 hours. It knows that you've got a set amount of BTC over a set amount of time, and it's going to try to trade more when more volume is traded and less when less volume is traded. Right? So you're trying to get your price in line with what most other traders are trading during that time, because whenever the highest volume comes in, that's where most people are trading. And so you'll be trading more there as well. So again, it's not good or bad. It's just a tool, right? If the price spikes a lot, then you might get a worse average price than just buying early on in the day. But if the price falls, then you're going to get a better price. So they can't work against the market. That's up to luck and when you execute, but it just gives you a little bit more of an option of spreading the order out over the day to get an average price of what the market actually traded as well. I'll leave a deposit bonus to Binance if you don't have an account yet. Some other helpful videos down in the description as well. I'm James, this is MoneyZG. Cheers for watching, and I'll see you in the next one.